The February numbers for the Toronto real estate market are out, and to my surprise, I noticed that average home sale prices are up 1.1%. Now, this is completely different as to what we've experienced over the past year. With interest rates moving higher, the Toronto real estate market has fallen. But why? Why has the market been resilient over this past month? Is it because the Bank of Canada has decided to pause its interest rate hikes? We're going to be looking at some of the verbiage that we heard this week from the bank. We're also going to be taking a look at what the big six banks are predicting for the future of real estate here in Canada. And more importantly, we're going to be taking a look at the jobs report. And the jobs report is important because that is one of the future determinants of where the interest rate could go. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. Before we get into the video, I have a huge favor, a huge ask. If you learn something new or you get some value out of the video, hit that like button. I definitely appreciate that. And we drop content like this every single Sunday, so make sure to come back and check out the channel. We all know that interest rates play a huge part as to what's going on in the housing market. And as the interest rates rose over the past year, we see that housing prices have come off. It's become more expensive for people to afford their mortgages. And that's why these numbers in the housing report for Toronto have come to a little bit of a shock to me. But let's focus on what the Bank of Canada said this week that may have tricked real estate investors around the market. So Carolyn Rogers, who's the senior deputy governor of the Bank of Canada, said on Thursday that while officials have seen a mixed picture of economic data since January, things are unfolding broadly in line with the forecast. We'll need to see more evidence to fully assess whether monetary policy is restrictive enough to return to inflation of 2%. So what they're saying here is that the economy is definitely weakening. We've seen the fact that the inflation rate has come down. We've seen housing start to fall off, and right now it's a wait and see game. And I think you're going to hear that saying a little bit later on in the video, but right now they're going to wait to see what the current interest rate increases have done to the economy as it is. This will now enable investors to determine what the potential 5-year fixed mortgage rate is going to be now that things have stabilized, and could that be a factor as to why people are starting to get back into the real estate game, or is it a lack of liquidity? We definitely see that homes on the market aren't as rampant as we've seen in the past, but that is something just to keep in our back pocket. But when Carolyn talks about this 2% inflation rate, it is important to note that the average inflation rate of Canada is actually sitting around the 3% mark. So it's kind of confusing when I do all this homework. I know the Bank of Canada's mandate is 2% over the long run, but when we look over the long run, our inflation rate has actually been around 3%. Now, is this achievable seeing that we've been at that 6-7% inflation rate? Yes, maybe, but maybe we should start reconfiguring where our actual expectations are, especially when we look at inflation over the short run. With that being said, let's take a look at what the big six banks are predicting in terms of what's going to happen this year in the real estate market. This article on Better Dwelling came out on March 9th, saying only one of Canada's big six banks is actually expecting real estate prices to rise. We'll start with RBC, and they are the only one that is predicting higher home prices next year. They expect prices to rise 2.6% by next year. Now, this is something that is kind of contradictory because we look further on later in the article and they have a separate division coming out and saying that they believe we are only halfway through the correction, meaning that there is about 15% more in a real estate decline to happen across Canada. So although one division is saying they expect prices to rise over the next year, another facet of the organization is actually predicting a downside. Then we have National Bank, and they are the second most bullish. They are predicting that prices are falling 9.6% over the next year. And then over the 4 years after, we can expect a 1.3% compound annual growth rate, and that's about 4.8 lower than the current numbers that we're at today. CIBC, on the other hand, is expecting that Canadian real estate prices will gain 2% over the next 5 years, but it's going to fall another 10.2% over the next year. Scotiabank, on the other hand, sees real estate prices down for a while. They expect prices to fall 12.3% over the next year, with a 0.3 compound annual growth rate over the next 4 years. BMO is definitely the most bearish. They expect the home prices are going to fall by 14% next year, with a 5.2% compound annual growth rate over the next 4 years. All in all, we have a very bearish indication from the big banks as to where the real estate market is going to go. And more specifically, when we look at this RBC Special Report, we can see the Bank of Canada may be done hiking rates, but it's not about to cut. So obviously the Bank of Canada has held and paused on its interest rate, but again, inflation continues to be relatively high outside of what their indicated 2% number is, and they will have to keep these interest rates high to flush that out. The economy is still running strong, but let's read a little bit further. So any downward drift in a longer term bond yield, which is RBC's call over the next year, is likely to be viewed as a positive sign of a turnaround. These factors will help to stabilize the market but not prop it up. We see the interest rate environment remaining restrictive for a while, and the Bank of Canada abstaining from cutting rates until 2024. So we're still going to be in this environment, and what they mean by the government bond yield is the 5-year Canadian bond, which is how the banks set the 5-year fixed rate. And when we do look at the past action over this past week, it has definitely come down a bit, and when we look at what the trend has been year to date, we can see it's fallen off from that mid 3% to now low 3%. And what this means is that the banks normally add a 1 to 2% premium on top of that, and now that it's stabilizing, we'll definitely see a little bit of calmness in the real estate market, but definitely not this expected increase that kind of maybe the Toronto real estate market was signaling there in February. And not only on the inflation topic, which we know the Bank of Canada is using as one of its determinants to figure out where their interest rate is going, the jobs report is equally as important. They want to see how many new jobs there is, to which we got a new report on Friday and it came out better than expected. So the economy is still kind of running at full blast with 22,000 new jobs added when it was only expected to be around 10,000. But let's read what the economists are saying about this job report. So Doug Porter, who's the chief economist at BMO, says there's simply no sign that the labor market is succumbing whatsoever to the rapid fire tightening of the past year. They're not adjusting their call on the Bank of Canada yet, but the economy is likely one wrong turn on the inflation front away from the bank flipping back to a rate hiking mode. So they're definitely seeing the economy is still running hot. And then on April 12th, when the Bank of Canada is set to report its next interest rate decision, we could potentially be going higher. Royce Mendez, the managing director of Desjardins, has said that evidence is accumulating that the labor market is not following the Bank of Canada's plan, and markets will continue to price in high odds of another Bank of Canada rate hike after seeing these numbers. James Orlando, who's a director and senior economist at TD Economics, says that although the Bank of Canada has been effective at slowing parts of the economy, we are very sensitive to interest rates. A lot of our GDP is wrapped up in the housing market, and we've seen inflation decelerate confidently, and a more decisive turn is needed. Given that the Bank of Canada is in wait and see mode with its conditional pause, it believes that it's not only a matter of time before a slowdown shows up, but with today's labor market report, we may have to wait a little bit longer. So what we're seeing from a facet of these economists is that the jobs report, the underlying economy is still running hot, and we are not factoring out a Bank of Canada rate hike, especially that the rate hike this week killed the Canadian dollar, which will make us buying goods outside of the border more expensive. A lot of companies import goods. They buy those goods in US dollar. The US dollar has become more expensive, and that will actually trickle inflation higher. So these jobs report numbers, the CPI numbers, are still super important as to what the bank is going to do in the future. And what these economists again are saying is that we don't know what these numbers are going to come out with, and we still have to put on the table, factor in that the bank could go higher in April. So right now, I think the real estate market is still very tight to get into. It's still something that I would be sitting on the sidelines waiting to see what's going to happen. And obviously these interest rates play a huge determinant of where we're gonna go. But let me know what your thoughts are. Did the February report kind of come out bullish for you? Are you excited to see what's going to happen? Or are you still sitting on the sidelines waiting and seeing? But if you're still with me, I appreciate all of your support. Make sure to subscribe to the channel. We do a new video like this every single Sunday. I hope you all enjoy your week. Have a great week in the markets. Happy trading.